Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. We just wrapped up our interview with Mark Perlberg, CPA and certified tax coach. Anthony, what was a takeaway or two that you had?
I would tell you, I really enjoyed this podcast. We just love hanging out with CPAs.
You guys were geeking out.
Yeah, I have to honestly, and this might not come across.
You gonna say it?
I'm going to say it, but I'm going to do a disclaimer. It's just so I don't sound like too pompous. But we've interviewed a lot of CPAs, and I would say that I learned some stuff here.
Wow.
He brought up some good stuff and very interested in the oil and gas. And he talked about some strategies where you can create some of these deductions to offset your W-2 income and some of those strategies that I hadn't heard for. But I think in summary, it just shows there's a difference between a CPA just preparing your taxes and planning for that preparation. And if you're paying a lot of money in taxes, I think it would behoove you to do some tax planning. I did say behoove.
Man, that's cool. Yeah. Two takeaways I had is that Anthony actually learned something today.
Yeah.
I'm surprised.
I haven't
200 and something episodes and Anthony learned something. Finally. Takeaway that I've got is that one thing, kind of with the rise of social media, right? You see a whole bunch of people talking about how great real estate investing is or tax planning is, but it's always in like 30-second snippets, maybe a minute snippet. And today I think we went over a half hour talking to Mark about some of these strategies, and really to understand them and then even more so implement them, is you do need to devote the time to kind of get acquainted with them, understand them at a much deeper level. And so one, he touched on a lot of topics that could work for a lot of our clients. So I'm excited for you guys to listen to that. But second is that, man, he's offered up the ability to get into his community.
Oh, yeah.
You don't have to be a client, right? So to jump in there and to be able to have access to somebody that is aware of a whole lot of strategies that even this guy doesn't know about, right? So what a great opportunity. And again, hope you guys find value in our interview with Mark Perlberg. Again, he's a CPA and certified tax coach. His practice is focused on creating tax planning and implementing tax strategies to help real estate investors and business owners to achieve financial freedom. Hope you guys enjoy this episode.
Take care.
If you're an investor or want to be an investor and you're looking to create passive income that exceeds your monthly expenses, then this is the podcast for you. Here on the Infinite Wealth Podcast, we combine the philosophies of Robert Kiyosaki's Rich Dad Poor Dad along with Nelson Nash's infinite banking concept. Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. And today we are joined by Mark Perlberg. Mark, we are excited to have you.
Yeah, thanks for having me.
Absolutely, man. We're going to dive into some kind of tax planning strategies and some of the things that real estate investors and business owners can be doing now today, kind of some practical applications. Man, but before that, let's dive in a little bit about your background. Let's introduce you to our listeners. And were you born knowing that you wanted to be a CPA, like my friend Anthony over here, right? Were you a little kid running around with an abacus, right, and a little pocket protector?
I would say that the first job I think I ever wanted to have was to be a motorcycle stunt driver guy.
Evel Knievel.
That's a good macho.
Which is
that CPA,
pretty much the same driver.
Thing. Yeah, same, different.
Oh, totally.
Did you hit your head riding your motorcycle and then settled for accounting? How did that work out?
Yeah, so I actually, in my past life, I was a teacher. I was teaching social studies in New York City, and actually selling real estate to afford my education. And I did that in 2008. The market crashed, so I couldn't make a buck selling real estate. And the real estate financed the schools, which went broke and laid off teachers. And there was a citywide hiring freeze, so I couldn't really get real work as a teacher.
Oh, jeez.
So
now I'm feeling bad here. Yeah, I was giving you a hard time. Yeah,
I had some bad luck, and I think it's good to have bad luck and misfortune early in your career. Mm-hmm. Really cut your teeth and experience real adversity. and have those lessons early. And so after pursuing those fields and realizing that I didn't want to do any of that or live in New York City, I just realized I had always been good at math and I was still interested in real estate. So why not double down on my greatest strengths and specialize in real estate? So that eventually led me to getting my master's in accounting, CPA license, and starting the firm specializing in tax reduction. And now what we're doing is we help entrepreneurs, real estate investors, and high income earners navigate the tax code and create financial freedom through tax strategy.
Man,
that sounds good.
It does sound good. And one of the things that I would point out is that sounds completely opposite to what I think most CPAs are doing.
Yes.
Right. This is my personal opinion, is I feel like a lot of CPAs are reactive, right? They're not actually doing any sort of planning or kind of forward thinking. Why is that, right? What I tell clients is that, man, if you can find one of those, they're worth their weight in gold. But why is that attractive? Why are you guys in that space?
Yeah, well, I think the bar is kind of low, and there's a few reasons why. Is the CPA profession, to be a CPA, you don't have to learn how to reduce your clients' taxes to get certified. Also, a lot of people don't pay a lot in taxes, and they don't really need a tax plan. And because the tax code is so complex, there is a certain minimum investment you should be making if you want someone who could do tax planning. And if you don't make enough to justify a $5,000-$10,000, I would say at least a $10,000 investment into a CPA and tax planning, it may not make a lot of sense. So it may not be economical for a lot of the population to use this. A lot of people could be okay with plugging their W-2s into H&R Block's system and calling it a day. So for all those variables, and just because the profession does not not all the professional organizations are encouraging us to think strategically about our taxes, although they should. There's a lot of missed opportunities, and there's a lot of CPAs who have not learned how to structure their business to create tax savings for their clients. And you have to be deliberate. Now, it's not because unless you set aside enough time and have enough people, time and resources to comb through the tax code and continually stay updated on these strategies and collaborate with your client, which takes more time, requires more skillful workers, and therefore requires higher fees, you're not going to be able to just dabble and kind of do it. It's either you're in or out, and most people just aren't led to, don't know how to, and don't have the resources to strategize with their clients.
Mark, you'd mentioned, the missed opportunities. Could you expand on that?
Yeah, I mean, it can. I think that as soon as you start a business, have some sort of side hustle, at the very least, you should pay at least $1,000, hopefully more, to sit down with a tax advisor and understand what are the tax deductions, what's the tax treatment of this activity. So at the very minimum, understanding what an income statement is and what you can be writing off and what's the tax treatment of this income. That's the very basics, which most people don't get. Most people are kind of figuring this out. And past that, then depending on how profitable, oh, look, we got another cat here. She's not as bad as Grouch.
You got, Mark?
Well, as long as she doesn't mess up the mic, we can let her stay. But no, they always like to go behind the TVs, but she's not going to be as stubborn. Sorry, buddy. So, depending on how much profit or even how much W-2 income is going to determine how deep we can explore these tax planning strategies that can maybe create a couple thousand every year and compound, or can we create hundreds of thousands or millions of dollars of annual savings?
Awesome. And I do want to dive into those. I got a question. You said, so when somebody's first getting started out, right, is, hey, take $1,000, maybe some more, go find somebody like yourself that's forward thinking, right, and more of a planner. How would, on the other side of it is, how would someone determine if they're overpaying in taxes?
Yeah, well, with us and with a lot of firms, if you suspect that you're overpaying in taxes, you can pay for an initial consultation. We do a lot of times free discovery sessions because it only takes 10 minutes to determine if they are overpaying in taxes. And so just find someone who specializes in tax planning, someone who's done at least 100 tax plans, who knows all the different situations. I mean, I can talk to someone and usually in 5 minutes, I know if they're overpaying in taxes or not and what kind of opportunities there are.
Awesome. If we're looking at kind of our cross section of clients, right, real estate investors and business owners, does everybody need a tax strategy, or is it just isolated to a few different people?
You know, I would think maybe not everyone here, because let's say you make $75,000 a year and you have a single family rental. There's not a whole lot of meat on the bone in tax savings. So if you're paying minimal taxes, or maybe even if you're just, let's say you're a full-time real estate investor and all your income is real estate and you're not paying taxes because the depreciation is offsetting your revenues, maybe basic filing and accurate filing helps you reach your goal. So, I mean, I guess to determine whether you need a tax strategy is really a case-by-case basis, but I would say you should know what the opportunities are, because even if you're not a high income earner, you may find that with just a few adjustments, you can reduce your taxes. Even if you're making, let's say you're making 150 to 200,000, you discover the short-term rental loophole. Well, now you have a tax strategy. If you don't want to do it, you want to do long-term rentals, that's not going to create so many advantages. You don't need a tax strategy. So I think you want to first at least be aware of what's out there and evaluate. It's really a case-by-case basis, but evaluate what opportunities out there and if it's worth investing into the tax strategy.
Now, you kind of brushed over there, Mark, about a short-term rental strategy. You mind unpacking that?
Yes. So we started doing this on the 2019 returns, and it's been one of the easiest ways to eliminate our clients' taxes. I mean, we've had instances where tons of clients, affluent clients, making anywhere from 200 to 600,000, maybe not that much, but maybe 500,000 a year, and completely eliminating their federal taxes. Under normal circumstances, when you have real estate losses, they cannot offset your ordinary income, and in particular, your income from your W-2 job. And that is because it goes into this passive bucket. Because it's so easy to create tax losses, the IRS limited what you can do with these losses. One of the exceptions of the rule here is if the average length of stay is 7 days or less, it no longer will fall into this passive bucket if you materially participate and self-manage. So now these losses will result most likely in a refund. So you can create tax losses from your short-term rentals, and then those will offset your W-2 income. And when you do your taxes, you get a refund. And then we maximize this tax deduction through general write-offs and tax strategies, and in particular with cost segregation, which allows us to accelerate that depreciation. And now we're creating some pretty significant tax savings and tax refunds.
Okay, well, it's great because it's rare when somebody has a W-2. It's difficult to incorporate some tax strategies, but it sounds like short-term rental can be a great advantage. What are some other advantages that somebody who has a lot of income on a W-2 do? Yeah,
so there are other ways. Now, I love opportunities to create bonus depreciation, especially with financed assets like real estate, because this gives you the opportunity where the cash that leaves your pocket is less than your tax deduction and maybe less than your savings. You create a refund that can be reinvested. Other types of businesses and side hustles. Heck, if you have a car rental business and you get bonus depreciation if the car is over 6,000 pounds, again, massive deductions that can offset your income. We've explored concepts such as, and this would be for the higher income earners, but equipment rental strategies where you finance equipment and rent it out. And that's 5-year life property gets bonus depreciation. Also, even solar panel rentals that gets you bonus depreciation and tax credits. And some of those tax credits can even offset prior year returns. So those are some of the things that we've explored. And then there are other ways to reduce your taxes in ways that are not going to create business taxes, but which will create charitable tax deductions. And there is a spectrum of how aggressive you want to be and in when you take these charitable tax deductions. But there are vehicles where the amount of a charitable deduction you get is going to exceed the amount of cash that leaves your pocket to get that charitable deduction, either because of valuation or the timing of the charitable deductions.
You got us speechless. That sounded interesting. Is this for, can you expand on that a little?
Yeah. So now I'm not recommending anything, and you need to evaluate the prospectus on all of these different situations. But there are instances where you can leverage your charitable tax deduction. So there are vehicles, and if you work with the right people and understand the legal structure of it, there are ways where you can actually borrow money that gets donated to a charity, and you get a charitable deduction of up to 60% against your AGI. There are vehicles where you can also get a tax deduction based on having assets that get donated to charity where the purchase price is less than the valuation. Now, these are highly contestable tax strategies, so there are risks involved. So you would want to evaluate this and also read some prospectuses and talk to a legal team to see if this is appropriate for you. We're not saying you should do this, but one of the things that we do is we educate our clients on all of the possible strategies out there. We don't tell them what to do, but these are some of the things that many of the high income earners and many politicians out there are doing with their taxes.
I like the term highly contested versus maybe red flag or, something they're looking at it, which is a proper way to determine it, because if we follow the tax code correctly, then we shouldn't have a problem.
Right. So a lot of these things are organized by tax attorneys who understand the tax law. And what I would think, if you want to make a purely logical decision, is you want to understand the people you're working with, the reputations, the history of these different financial strategies, understand what's the probability of anything being adjusted after the transaction takes place, to how much, what is the impact and potential risk, and is the risk worth the reward. And for people in really high brackets, because of the massive tax savings, and when they've evaluated worst case scenarios, some will go with a more aggressive charitable deduction strategy, and there are some other ones that are more conservative. And in fact, there are ways to invest into real estate that create charitable tax deductions and cash flow and future capital gains. So this is the stuff. This is why I say, there's a spectrum of tax strategies and opportunities. And some of these things take a ton of research and conversations and legal. While we are not attorneys, we need to educate our clients. We don't want our clients bringing strategies to us. It's our responsibility to educate them on what's there. And also, if things are illegal, we would never, ever, ever recommend that a client did something unethical or that would be not in their interest. But we want our clients to understand what is available in the tax law.
Now, Mark, one thing we've heard a lot about, particularly recently, is people investing in oil and gas.
Love it.
Do you mind explain kind of what those tax advantages are?
Yeah. So, and oil and gas is not anything. We're not, like I said earlier, there's some subjectivity and ambiguity, or maybe there may be arguments over some of the charitable strategies. Oil and gas is you are taking advantage of a tax incentive in the tax code to encourage the development of energy, because the U.S. needs energy. And if you go to other countries that don't have access to ample supplies of oil and gas, look at the prices of the oil there. So you're taking advantage of an incentive to invest and help develop oil and gas industries. And the way it's going to work is you are going to contribute to a partnership, and you are going to get a tax deduction for what's called intangible drilling costs in year one. Typically, that amount comes to between 80 to 90% of your contribution into this partnership. You don't have to materially participate or really do anything at all. So I love this strategy for people who want to save money on taxes, build wealth, get cash flow, but do not want to start a side hustle. So you're a limited partner. You just collect paycheck, right? So the year one, you get a decent tax deduction, 80 to 90% of your cap contribution, and that'll offset your W-2 income as well. And then in the following years, you're going to get distributions. You're going to get a share in the profit from this. And oftentimes we find that the profit share is pretty good. I like combining this with real estate. Let's say we can't use real estate to offset our taxes. Those real estate passive losses from the depreciation can now offset the future cash flow on our oil and gas. Another thing is, let's say you're a real estate agent or you have some other side hustle, you can also offset your self-employment tax. Not a lot of people know about it. That's an extra little bonus there. So oil and gas has been a really fun vehicle for our clients to explore. And they're investing. One of our clients is flying out to Houston and checking out the oil rigs. They're all finding this a very exciting and lucrative investment. And you're getting an initial tax savings up front to help, certainly that's going to help offset some of that risk you're going to take on that you would take on with any investment.
So, Mark, if you do this oil and gas and you start getting distributions, is that ordinary tax or capital gains?
It's taxed at your ordinary bracket, but it's passive income, meaning you wouldn't pay any payroll or self-employment tax.
Okay, so okay. Now I guess that's passive income. So thus, wow. Okay, I'm digesting this. This sounds great. Where you get that deduction and you can deduct it against, say, your W-2. And then the income that you do receive is passive income.
Correct.
So if you have passive losses that you normally are limited to take, this will allow you to take them.
Exactly. So let's say you have these losses trapped in this passive bucket because you can't use them. You don't have real estate professional or the short-term rentals. You say, well, hey, we invest in oil and gas. As soon as this starts generating profit, we'll activate these real estate losses to offset it. And that'll offset our profit. And we can still get the intangible drilling cost deductions, offsetting our W-2 income. So now what we always like to see with our strategies is how can we create tax savings that compound our wealth? We reinvest our tax savings into more cash flowing wealth building vehicles that can also continue to reduce our taxes.
Okay. Also, then I would imagine, I would tell you, Mark, not every CPA likes to hear this, but we have many clients that are freeing up their money that was an IRA or 401k. So they may have this big windfall. When freeing up the money, they got to pay taxes on this. Would they be, if they did, say they were to take that and buy an oil and gas, would they be able to use that deduction by offset the 401k or IRA distribution?
So it's ordinary, that's going to trigger ordinary income, which you can offset, but you're going to be subject to the excess business loss limitations, which is, I think, around $580,000 if you're married and half of that if you're single. But you know what I think is really cool here is if you have a capital gain event, let's say you sold some RSUs or some stock, whatever, and you put that money into oil and gas cannot offset capital gains. Now that sounds like a disadvantage, but to me, it's also an advantage because when you put that on your tax return and that deduction, it's not going to chip away at your cap gain. It's going to chip away at the income being taxed at the higher marginal tax bracket. And therefore you would need less losses from your oil and gas to offset that same amount of capital gains.
I'll explain that later.
Yeah, this is great.
That was some good stuff. But then also, Mark, I mean, they could just, the money they're taking out of their IRA, they could take a little pit stop through a policy and then run that through to the investment.
Absolutely. Yeah, so many ways to look at it, and so some of the more One of the things we want to at least be aware of is that you may have a 10% early withdrawal penalty if you're going to take your funds out early. And some of our clients say, heck, it's worth it because I'm going to invest into vehicles that are going to give me a really good return, or that is going to give me a boost, or I'm going to hire a coach or a consultant. It's going to give me a jump start in my career and getting to where I want to go, and that's fine. But you want to at least be aware of that additional tax there.
Yeah, there's that 10% penalty of keeping it in. But the question is, what's the penalty? I'm sorry, the 10% penalty for pulling it out. But what's that penalty for keeping it in? Lost opportunity costs that we're unable to use because we're restricted in what we can invest in.
Yeah, and I think the answer is different from different people. So for me, I'm an entrepreneur, I'm a hustler. I would find a way to deploy that in a way that would educate me and grow my skill sets. And I like to invest into myself and my team. But let's say you already have the cash, or let's say you're not going to really do much else with it. You might just roll it into a Roth and have it grow tax-free. So everybody's DNA and investment profile and what to do with their cash might be a little different.
Mark, we're going to forgive you for using swear words. I'm telling people to put money in a Roth, but I mean, we're just joking, but there's a lot of advantages of really freeing up that money for and to get out of it from paying taxes. Still locked up in a Roth, but I would rather have a Roth than a traditional.
Yeah, I mean, and then the thing about a lot of our clients and entrepreneurs, they're not crazy about the Roths unless they're older. Because, when you're starting off with your entrepreneurial endeavors and you find out you got to wait until you're 59 and a half to take the funds out, and you need those funds to reinvest into yourself and your entrepreneurial endeavors, suddenly the Roth IRA isn't that intriguing for a lot of our clients, which is why things like infinite banking, where you can actually access your cash and still grow it tax-free without waiting so long, is an appealing vehicle for entrepreneurs who are looking to build and compound their wealth with their own investments.
Agree. Mark, if somebody's listening, right, we've touched on some advanced strategies and some other stuff. If somebody's listening, like what's a wheelhouse, right, that somebody's listening and would be a great prospect, or they're like, man, you know what, this would work really well for me. Is there somebody that you kind of target there?
Yeah. So our sweet spot where we look for people with tax problems, because we can solve big tax problems. So in the one, we would say our target demographic would be 1 to 5 million in revenue as business owners, or 750 as W-2 income earners. But we try to help out everyone we can. So if you're interested in some of these concepts and wonder if and how they apply, shoot us an email, get on our mailing list. We have a free community. I go live and talk to people for free all the time. I love talking to people about taxes, giving out pointers. I would do it for free if I didn't need to support my staff. So just get engaged, get on our mailing list, because we do free live webinars and answer everybody's question as much as we can. But because of some of these strategies take a lot of research and follow-up and documentation, that's our sweet spot where we're most likely to take you on as a regular client.
Well, Mark, one thing I wanted to tell you, we kind of brushed over it, but you were talking about how it could be potentially, if you're a real estate investor, that you could have these losses locked up.
Yes.
Can you maybe expand why they're locked up and maybe what we can do to unlock them?
Absolutely. So, and I believe it was in 1989 where basically the legislation found it was just too easy to create these tax losses. So affluent, attorneys and doctors were creating tax losses from these real estate investments and giving themselves refunds and paying minimal taxes. So they said, we're going to create Code Section 469. We're going to define what passive losses are, and they're going to be separate from ordinary income. So when you have passive losses from long-term rentals or just typical rental activities, mobile home parks, self-storage, commercial, that's going to be in this passive income bucket, and it will almost never offset your active income. One exception, you get a little bit of that deduction if your income is under $150,000. But for the most part, you're going to accumulate all of these losses because they can't offset anything. And the depreciation, and because even if you're profitable in your real estate, it's not that hard to create tax losses with all this depreciation. So you're going to build up, or if you can't use these losses, if you don't have real estate professional for you or your spouse or short-term rentals, you're going to accumulate a reserve of losses. And if you don't use it, you lose it. You may die with a lot of them, but they can be activated. They can be used to offset a passive income generator, like if you're investing passively in partnerships and other passive income sources where you're not actively involved in businesses, not portfolio, not stock income.
Right.
They can also offset future capital gains. So when you sell these properties for a profit in the future, you'll be able to draw from these unused losses to offset the future capital gain.
Now, you also mentioned real estate professional. Would you mind explaining what that means and the advantages of meeting that criteria?
Absolutely. So we talked about how it's easy to create tax losses and you can accelerate the depreciation, create hundreds of thousands of dollars of deductions. If you or your spouse, only one of you is working full-time in real estate, so you could be a house flipper, real estate agent, real estate investor. By full-time, I mean 750 hours or more and more than 50% of your working hours. So you likely can't do this with the W-2. Then you can now claim that real estate professional tax status and use those losses to offset your W-2 income. To give you an example, and this is very popular, you have one high income earning spouse who's maybe like a physician making maybe 800,000. And then the husband or wife of that person becomes a real estate agent, works from home, watches after the kids, or just uses some of that cash to invest into real estate. Now we can run those cost tags and create those non-passive losses and get a refund from the highly taxed, high paid W-2 income stream.
Mm. Now, is that something that you help clients document and execute?
Absolutely. So, based on the IRS's guidance of what needs to be documented to substantiate that tax election, and also back to material participation, we help them understand if this is feasible and what documentation needs to be available to substantiate this position.
Awesome, Mark. Is if somebody's listening, where's the best place for them to go to, or is there an email that they can reach you at?
Yeah, if you want to email me, email info@markperlbergcpa.com. I think if you find any of this interesting, just follow us on YouTube, but really get on our mailing list because we do a lot of live conversations, at least one a month, sometimes 2 to 3 a month, where you can hop in and ask us questions and connect with us. And you'll also see a form if you think you're ready or want to use us for your services. Just fill out that form and you can be a prospective client.
Did I hear that correctly? That the community is open, right? They don't have to be a client. Is that right?
Correct.
Nice. Awesome. Nice little
There's
service.
some great value there.
Absolutely.
Yeah. So, and like I said, we try to help out as many people as we can. So I try to do group settings and conversations. I haven't even figured out a way to monetize it yet. And not a lot of people show up because I don't really market it because I got too much other stuff going. So when I promote these live events, here's an opportunity where, let's say you're not quite ready for someone who does things at our level. You can certainly, you have an opportunity to have conversations with me. You just got to keep in the loop with what we're doing.
Awesome.
Yeah, what a great opportunity. Mark, thanks for sharing and really appreciate you coming on today. One last time, can you share that email that people can reach out to you at?
Absolutely. info@markperlbergcpa.com, and also go to markperlbergcpa.com to get on our mailing list and see if you want to be one of our clients.
Now, Mark, don't you also have a podcast? I don't think you mentioned that.
We got the Mark Perlberg CPA podcast, and also search Mark Perlberg CPA on YouTube. You'll find tons of stuff, including 2 conversations on oil and gas. We have a conversation on the real estate professional tax status and the short-term rental loophole. All those things we touched on, we'll dive deeper on if you want to check out the site.
Fantastic, Mark. Well, we appreciate your time. I know we're kind of in the middle of tax season, but we appreciate you coming on and spreading some of your information to our clients.
Absolutely. Hey, thanks for having me. Always enjoy these conversations. and we'll keep in touch.
Awesome. Thanks, Mark. Appreciate it.
Thanks. Go make it a fantastic day.
Take care, man.
You too.
If you like this video, I know you're like this one. And if you want to learn how investors use infinite banking to increase their returns and lower their taxes, check this out. And if you have some questions and want to see if infinite banking is for you, hop on a discovery call with us. Link for that will be in the description.